I am Simi Kedia, Professor of Finance and Economics, Rutgers Business School. I've been working on corporate misconduct, and in this paper we were looking at contagion, which is basically do firms copy and mimic bad practices from each other. So in this paper, Evidence on Contagion in Earnings Management, we looked at a period of about 11 years, from 1997 to 2008, and we looked about 2,476 restatements, and I observed some patterns in the data that you see this, if you wish, clustering in wrongful practices. So essentially what we do is we look at a firm's decision to begin cheating, and we see whether or not it is after they find someone else who has been caught for cheating. If firms observe other firms getting caught and they find that, there wasn't that much of a penalty in cheating, they are going to cheat as well. You see this in other aspects of life. So for example, if you're driving on the highway and you see a lot of other cars well above the speed limit speeding, you kind of feel that, well, perhaps this stretch of road doesn't have a cop and everybody is speeding, and so you also tend to speed. And if you get in a stretch where everybody's in the speed limit, then you're a little bit more inclined to also observe the speed limit. So in some ways it is not surprising that you observe this contagion even in corporate misconduct, but what was surprising is that it has been so costly to business and to the economy to have this misconduct. So the problem with incorrect disclosure is that the shareholders are misled as to the performance of the firm. It is unfair on the investor who buys the shares today without knowing what the true earnings are. And it is the SEC's job as the regulator that all disclosure is truthful and relevant as of now. Whatever it is you know today has to be correctly disclosed to the shareholders so that all sales and purchases in the market are made with everybody knowing the same information, which is correct for that moment.